You were expecting something of asymmetric sort of cut in the LPR. Why do you think, what's the message that we're getting from the PBOC on this decision now?
Correct. So we were expecting, perhaps naively, some asymmetric rate cut focusing on the 5-year loan prime rate, which is, of course, used to price mortgages. I think we get two messages from the 10 basis points on the 5 and the 1 year. The first message is that they are going to be very targeted. So they didn't do 15, they did 10, which was less than expected. And the second key message is that this is no longer a problem of a slowdown in the housing sector. This is a broader issue affecting the manufacturing sector, the investment, and so they need to do broad-based measures to stimulate the economy. It's not only about the housing sector anymore.
Such as?
We expect that they will follow up with a package of measures. We saw the financial stability law being passed in April, and that could pave the way for balance sheet expansion. PBOC has, of course, been contracting its balance sheet since the beginning of the year, but they do have some room. Government debt as a percentage of the balance sheet is only less than 5% compared to 55% in the US or 80% in Japan. So we think that they could use some of that PBOC liquidity to support some key sectors in the economy, of course, real estate developers being one of them. But that, again, will not be enough. So we also want to see macroprudential support measures to the housing sector, and we also want to see more targeted measures to boost consumption across EVs and household goods as well. So it's going to have to be a very scattered bottom-up package. And of course, we saw a 10 instead of a 15 basis point rate cut. So this is not a 2008-style bazooka. This is still a targeted package. It has to be comprehensive and targeted in order for them to meet the growth target.
Yeah, I mean, it's not so much, as you said, broad-based. I have to wonder then, in terms of what we're expecting in terms of growth then, is the 5%, is that an easy target at this point, or it's still something that is a bit of a high bar?
We got quite spooked at the pace of sequential deceleration in the second quarter. So structurally, yes, China's economy has been on a downtrend since 2013. But we did expect a cyclical uptick this year. And we got that in Q1 and then a sequential deceleration in Q2. So we've revised our growth forecast from 6% to 5.5%. And I would say that risks currently are tilted to the downside. There's a base effect pending. But if they don't do more, unfortunately, that 5% target might remain elusive. So that's why we are expecting more measures to come.
But there's a lot of stuff taken on the monetary side, but not so much on the fiscal, given their debt position and where local governments are. We're talking about non-financial debt of about 300% to GDP. I mean, that is huge, and that's on top of what we have in terms of the overall debt load as well. Now, is the other point of stimulus here coming from the currency market, because it seems to be quite, it's not even benign neglect as far as what is going on is an effective devaluation. How does that help the economy?
That's a very good point. So part of the package of measures includes some currency depreciation. I think a strong yuan is not beneficial for them at this point in time. They don't want to lose more export market share to other Asian countries. However, competitive devaluation like what we saw in 2016 would aggravate existing financial risks. This year, of course, most of those risks are concentrated around the local government financing vehicles. So we do expect to see that remain a theme. And so they will have to maintain things accommodative, keep the yuan weak compared to the basket of currencies. The US dollar view is slightly different. And then hopefully the export market share won't drop too much in the second half of this year.